Joe, the market's facing a little bit of pressure right here. We're down 39 basis points so far today. Is this the beginning of a crash? Are all the people on the internet who said it can't go any higher finally going to be right after this huge? In fact, hang on. How much has it gone up since the bottom to where we are right now? This impossible, it's never going to happen rally that went up 14% on the market. That's 2 years worth of gains, basically, on average, right there in the span of just a month or so. Yeah, it can't possibly go. For all the people who want to continue to call the crash, just stop. Just stop already. Let the market tell you where it's going. Okay. It makes it so much easier when you do that. So Joe and I are going to go through the trading plan for the day, and then we're going to talk about this video right here. If war bad, why stocks go up? I think that's pretty apropos for this topic today because we're hitting almost new all-time highs, very close, but it is a very ever slightly tiny itty bitty baby pullback. And listen, this is the Outlier Trading Room, where I help you save time, make money, and start winning with less risk. So go ahead and subscribe if you haven't already. Joe, we're so close. We're closing in. We're a few hundred away now from hitting 50,000 on my channel. So for those watching the replay, be sure you hit subscribe. All right. Let's go through our market update real quick. Geez, there we go. Let's go through our market update, see what's going on today. First, where's money going today? It's actually pretty chill out in the market. I don't see really any big red candles. I mean, you got a little bit of a Home Depot, that area that's taking a hit over there. You've got some chemical factories over here, it looks like. Overall, pretty muted, right? I do see more red than green, but a couple stories out there. One that I want to talk about right here, Palantir. Palantir's up bigly today, 2.6%. Let's go to Palantir real quick, PLTR. Now, Palantir has earnings after the close, and you've got to keep an eye on earnings. In fact, this is a fantastic channel to go follow, Earnings Whispers. And I was looking on this just a little bit ago, and I saw Palantir has after the close earnings. And Joe, this is exactly what I love to trade: the buy the rumor, sell the news type of trade. Now, of course, I'm not in this trade. I have no money associated with this trade right here. But it did pull up, man. It is pulling up right here from this bottom of this candle to where we are today. Palantir's gone up like 10%, literally 10% on the nose almost. So nice move here on Palantir. But of course, anything can happen after earnings. Anything can happen after earnings, and we don't want you to get monkey hammered. So anytime you see earnings coming up, it's a great idea to take risk off the table. And I'm just going to pull one at random. Let's go to CNA. They had earnings this morning. What happened to this? CNA. All right. Oh, that literally was random. I did not look at this ahead of time. That's why you take money off the Joe. Did you expect to see the biggest, nastiest? That could be the worst red candle I've ever seen.
Yeah, that's a nasty one. It's perfect example of watch yourself when earnings is near.
Joe, that was not planned. I wish I could take credit for doing that ahead of time, but goodness gravy, that, my friends, is exactly why you don't want to hold through earnings. And also, look at Order Block City right here. Look at Order Block City. Hang on. Speaking of Order Block City, new merch drop. Merch drop as of today over at outliermerch.com. New merch drop for Order Block City. Have you seen this yet?
Let's see. Nice. Yeah, I saw that.
Yeah, look at that. Cool. Order Block City with a little ninja hacker or ninja roller in the background. The candles representing buildings. Holy moly, that's Order Block City, my friends. That's what it looks like in real life. So pretty cool to see. Okay, so moving on from that, I did see one other one that I wanted to talk about. Sound. This is SoundHound. This is one that the Invest with Corey channel has been pushing for a long time. Let's go look at Sound real quick. SOUN. Yeah, I mean, it's finally starting to turn around, right? I don't know why the apes love it so much. Surely it's got a great story to go with it, but it's starting to turn around. It went from around $5 or so to $9 or so. So it's doubled in the last couple of weeks. That's a great start. But again, you got earnings right here, my friends. Don't be surprised if the monkey hammer is waiting around the corner, ready to take you out. So yeah, just be really cool. All right. So just be chill on stocks like that before earnings. So Joe, I have one trade on in plan M, and I want to take a look at it, and maybe we can even put on some new trades today, right? But we need to start by reducing risk before adding new trades because the most important part of the plan is planning on the plan not going to plan. So let's first look at our plan M exit signals. The only trade I have on still is NVIDIA. Right? The one stock in that sector that didn't just like rip higher. You look at AMD, you look at Micron, you look at SanDisk, they're all like hundreds and hundreds of percents higher. AMD or NVIDIA did great. I've rolled it enough times where I have an absolutely free trade in here. But man, this one just is not lighting me up like I wanted it to. It's not lighting me up like I wanted it to, but it is finding some support here at the 20 EMA, right? At the 20 EMA, you can see buyers are starting to step in and build a little support. And I was looking at the chart a little bit back here, right? It's not the first time where it's been in an uptrend and then found some consolidation. You can see right here back in May of last year, it went gangbusters, ran into an order block. Tell me order blocks don't work. Found some support on the 10 and then gangbusters after that. So, hey, fingers crossed, that's what will happen here right off the 20 EMA. But then again, I don't know what's going to happen. That's why I have a trading plan. So first, does it have an outlier sell signal? In fact, it still has a buy signal in place. So that makes it easy. Everything else is chart based. And the chart based is really simple. It's so simple, in fact, that Chris Chains can help us remember exactly what to do.
Cost, blocks, earnings, stops, and exit. Oh, that's how outliers roll.
It's pretty easy, right? A 1020 cross, run to an order block, earnings, or it hits one of the stops. And then that's the exit signal. Not before then, right? Not before then. Now, of course, you're probably sitting at your living room watching this and you're like, this guy calls himself a professional investor. He didn't get out the very top candle. Y'all let me know when the very top candle happens so I can be sure to get out on that candle next time, okay? Let me know when that is, and I'll be sure to follow your plan because I'm sure you definitely knew where that top candle was. But I don't. But I do have a plan that has a back-tested edge. And like I say, this is already a risk-free trade to me, so I have guaranteed profit. So I'm not really stressed on it. Just following my plan. So 1020 cross, no. Blocks, no. Earnings are 16 days out, and stops are way down here. So nothing to do. So this is a hold for me. So next, let's see if there are any new trades to put on in plan M. So we're going to start with the market. So the SPY needs to have a bullish trend in place. SPY needs to have a bullish trend in place. And what I see right here is a bullish trend. It makes it too easy for you because it lights it up green. When the 10's over the 20, prices over the 50, that is a bullish trend. A mathematical certainty of which direction it's going. Can't show you magnitude, can't show you duration, but it can show you direction without a doubt. And SPY has a buy signal. Still sitting on that buy signal. It came through since April 9th, has been running up ever higher since then. And by the way, that was exactly when everybody was terrified, saying, you can't buy. The Iran war, everything is bad. Everything's horrible. You can't buy here. The market did not care. And neither did Outlier with that buy signal right there. Pretty cool, right? Now remember, these don't see the future. They're just reacting on the data that we have at our fingertips. Next, we want to see the SPY fear and greed heat map under 70 and rising. Well, it is rising, but it's at 83.16. At 83.16. So it's over greedy at this point. Now, there is an interesting divergence because down here, this is the average fear and greed score of everybody in the S&P 500, the constituent heat map right here. It's going down. It's at 58 and going down. So really interesting to note right there, Joe. What does it mean? I don't know. But I did add that to my list of things that I want to backtest. What does it mean when we see a divergence where the SPY is going off on its own and the average fear and greed scores much lower and going a different direction? There could be something to this. There absolutely could be something to this. So I'm not ready to say what that is yet. We got to run the data. So we got to figure it out. All right. So
You got to put Scott on that, Chris.
Scott's going to be on it for sure. Any minute now, Scott's going to get out of grad school and we're going to take him over. That's the plan. So because of that, Plan M is off the table. Now let's go to Plan ETF. Plan ETF, which I am presenting at the Tradier Conference on Friday at 11 a.m. West Coast or East Coast time. I'm very excited about that. So we have an uptrend in Qs and SPY. Qs and SPY both have a buy signal, but we just talked about how the SPY has a heat map score of 83 or something like that. You can go to market breadth over here and actually see this really, really easy. Really, really easy. Go to summary, and you can see the fear and greed score of SPY is at 83.16. The fear and greed score of the Qs is at 83.73. So both of these are off the table. Both of them are too greedy right now. So Joe, the only thing that I have on and the only thing that I'm going to keep on is my NVIDIA trade until I get an exit signal. And that's it. So your trading plan can be that simple, right? Once you have your rules and you know where you're going to get in and where you're going to get out, you don't have to sit there all day ruminating on what do I need to do. In fact, you can go watch some YouTube videos like we're going to do right now. Joe, let's watch this video. If the war's so bad, why are stocks up? I don't know. Let's find out.
32 p.m., Donald Trump announced a ceasefire with Iran. And from this announcement, we learned two things. First, Truth Social is the single greatest invention of our generation and is totally not a useless social media platform. And second, markets don't like uncertainty. Because the very next day after the announcement, the markets ripped. The S&P closed up 2.5%, the Nasdaq almost 3%, and the Dow climbed more than 1,300 points, which marked its best day in almost a year. But it didn't just stop there. Because a few weeks later, stocks were back at record highs, even as the ceasefire was actively falling apart in real time. Traditional financial media was calling this a relief rally, that the markets were celebrating peace, but the truth is, that's not what this was. This was something else entirely. But to understand what actually happened, why markets can be at all-time highs when there's a war going on, you first need to understand what Wall Street looked like going into this, because there's a lot more to this story than just a relief rally. On February 28th, the US and Israel launched joint airstrikes on Iran.
Let's mark on the chart where February 28th is real quick. February 28th is right. Well, the 27th is right here. That was a Friday. And the 10 was already under the 20 price was under the 50 at that point. Pretty interesting right there.
Supreme Leader Ali Khamenei was killed. Then Iran shut down the Strait of Hormuz, and the market had its worst 5-week losing streak in nearly 4 years. The S&P was down nearly 9% by the end of March. And while your retirement account was quietly screaming, there was something else happening underneath the surface. Wall Street was beginning to panic. Hedge funds didn't just start repositioning. They were selling at the fastest pace in 13 years. And that's not a loose estimate. That's hard data. Because Goldman Sachs had a front row seat to the show. They run what's called a prime brokerage desk, which services most of the major hedge funds on Wall Street, which means they see what these hedge funds are buying, what they're selling, and just how leveraged they are. And according to Goldman's own numbers, Q1 hedge fund selling in North America was the largest since April 2020. Gross leverage.
Hold on. I want to go back to this. Right. This is the type of doomer rhetoric where it's like, did you see hedge funds are selling at the biggest pace since 1920? Right. And it's like, oh my gosh, I can't believe the whole world is going to end. Now, granted, remember, we can't see the future. We don't have the Nancy Pelosi plan just yet. So it's somewhere probably on the downslope, right? And then that's like what I was saying earlier, right? When you get over here, there's so many people screaming, you can't buy, you can't buy, you can't buy. Yet when all your data lines up, the only thing you can do is follow your plan. And it seemed to work pretty well, but it didn't result in the worst crash ever in the history of time. So, and that's where I want to take another moment to talk, because there's so many people who want to espouse their opinions, which everybody's allowed to espouse their opinions, but you don't have to listen to them, Joe. Everybody's allowed to have an opinion, but most opinions smell bad, right? What do they say? It's like your elbows. Everybody's got two of them and they smell bad or something. My elbows don't smell bad. I don't know about yours. After you mow your yard, your elbows probably smell pretty bad, right, Joe?
I suspect you're probably right. Yeah.
But like, that's the thing, right? There's all I like to say there is always a reason not to trade. Plans are underrated. They keep you out of trouble. I know, they're so underrated. But there's always a reason not to trade. Let me find the slide for this, because it's actually quite a good slide. I definitely didn't steal this from somebody else, right? There's always a reason throughout the history of time to not take a trade. Yet, what do they have to do with anything, right? If the price is going to go up and you've got your plan in place, it may be time to just go in, right? And it can be scary. It can be scary, but it can also be rewarding. But if you have a plan, you know where you're going to get out anyway. Let's keep going.
One hedge fund selling in North America was the largest since April 2020. Gross leverage was sitting over 300%, near an all-time high. And short exposure to macro ETFs like SPY and QQQ hit the highest level since the pandemic. And then on March 19th, commodity analyst Rory Johnston said this:
if you think about some kind of massive detonation in the oil market supply chain in the Middle East, and there's this shockwave that's kind of moving out, this shock is too large for the system to handle, and it will begin to creak and break the longer this goes on.
Just how many barrels per day were those disruptions, the squeeze of 2008, and how big is this in comparison?
It's bigger than anything in history. Every analyst I speak with, people again that I respect, people that are not alarmists, people that make fun of the alarmists, they're all terrified. Let's say the East-West pipeline is maxed. There's no issues at Yanbu. The Houthis don't get involved, et cetera, et cetera. In that scenario, with the strait remaining closed, we still need to shed 15 million barrels a day of global demand. And that just means prices, $250, $300 a barrel Brent. Like we will hit all-time highs in that scenario on an inflation-adjusted basis, almost guaranteed, almost by necessity. So I do think in that scenario, again, recession is too light a term. We're talking depressionary.
Fast forward 6 weeks later, and this might be the funniest take of the year.
Well, that didn't age well, did it?
No.
That did not age well.
We'll come back to why in a second. But at this point, the sentiment on the street was pretty clear. Everyone was bearish. Then, on the evening of April 7th, Trump announced the
Oh, hang on. Where's April 7th? April 7th, right there. Where was that buy signal again? It was... Hold on.
I feel like it was the 9th.
Yes, the 9th. The 9th. So literally this candle right here, this green candle right here.
ceasefire. And when the markets opened the next morning, it was like someone turned Jerome Powell's money printer back on. Because over 400 names in the S&P finished green, 13 stocks printed all-time highs, Brent crude dropped around 13.5%, and WTI crude fell over 16%, marking the biggest single-day decline since April 2020. But here's where the mainstream explanation for all of this starts to break. According to maritime intelligence firm Windward, who utilizes AI to cross-reference digital GPS signals with satellite radar and imagery, only 5 outbound carriers were actually detected moving through the strait by midday. This is a roughly 96% decrease in activity compared to the pre-war baseline of around 130 daily transits through the Strait of Hormuz. So something's not adding up. How can there be a relief rally based on world peace, if there's actually no world peace? Which raises the question, what really moved the markets? And the answer is, a good old-fashioned short squeeze, and I can prove it. But for this to make sense, we first need...
All right, well, I'm curious, because remember, the S&P 500 is a market cap weighted index. So when this moves, it's because not just one stock got the short squeeze, but all of them, not all of them, but a lot of them, especially the big boys, they had the real moves. So, right, let's talk about what a short squeeze is real quick. Let's set the stage. CAR, Avis, had a short squeeze. So there were people who were short CAR back here. By the way, CAR got a buy signal on March 25th, and enormous gains were to be had. But the reason that short squeezes happen is because let's say that I went long Avis on this candle. Let's say it was $125. The most that I can lose is $125, right? If it went to zero, the most I could lose is $125. Does that make sense, Joe?
Mm-hmm. Yeah, perfect.
Yeah. But if you're short the stock, the most you can lose is infinity. Because if it goes up and you are short it, meaning you want it to go down, then you can lose significantly more than $125. By this line right here, the shorter, the person who went short, had lost $125. And it didn't stop. It went up biglier, way more biglier. In fact, it went up from the $125 level, roughly 600% at its peak. So imagine taking your money and losing 6 times that. That would suck. Yeah.
Ouch. That's awful.
Now I know you're thinking, but it came back down. It doesn't matter. You know what happens around right here? After
Margin call.
Probably 200%. You're getting margin called. That means your broker is going to eliminate your position for you. Tough monkeys. You get nothing, my friends.
It's all there, black and white, clear as crystal. You get nothing. You lose. Good day, sir.
So even though it did come back down, nobody knew when it was going to come back down. Of course, everybody's looking at this situation saying, this makes sense, right? It's a short squeeze. It's like GameStop in 2021. It'll come back down. But your broker don't care. Your broker will eliminate your position for you. You get to take the huge losses and tough monkeys. So these shorters, I guess is the right word to say it, the shorters are closing their position over and over and over. And you know what they do when they close their position, Joe? They have to buy back the shares, which pushes the price up even higher, right? Ouch. So it's a huge, huge, huge self-fulfilling prophecy. And this is when that imbalance of fear and greed comes into play. People are getting greedy, while at the same time, the shorts were getting very fearful. And so it all worked together to create this huge, massive short squeeze. Okay. So to say that there was a short squeeze on the market, my friend, you better bring receipts. Okay. Because the market is not one stock. The market is not just NVIDIA or just Google or just Apple. The market is, I don't know, like a couple, like 2 or 3 stocks, right? Maybe they were squeezing the index and not the individual stocks. Is that a thing? I don't know. Let's learn this together.
To explain the underlying mechanics of a short squeeze, because when you short a stock, you're borrowing shares from someone and selling them. You're betting the price drops so you can buy them back cheaper at a later date, return them, and profit the spread. But if the price goes up instead, you're fucked because you still have to return those shares you borrowed, which means you have to buy them back at a higher price than you sold them at. And if the price keeps rising, your losses keep growing. And at some point, your broker may send you a margin call, which means you either add more money to your account or you close the position immediately. And when enough people get margin calls at the same time, they all have to buy back their shares.
Joe, I don't know if I ever told you this. I've been margin called twice.
Oh, really?
Twice, yeah. And you know what? I was like, I'm not adding money to this. No, I'm done with I have thrown fuel on the fire enough. I'm done with this trade. Yeah, it's happened to me twice. Yeah.
Ouch. And that's when you quit selling options?
Yeah. Oh, yeah. Yeah. Yep. Exactly.
Pushes the price up, which triggers more margin calls, which triggers more buying, and that's a short squeeze. And on April 8th, when the macro short exposure was at the highest level since 2020, the squeeze began. But the squeeze was only the first domino to fall, because once stocks started ripping, the algorithms kicked in. And this is where the CTAs, or commodity trading advisors, enter the story.
Oh no!
Oh no!
Oh no!
Oh no!
Oh no! Oh yeah!
These are systematic trading firms that run on rules-based models. They don't care about news. They don't care about geopolitics. They just follow trends. When the trend is down, they're...
You know why, Joe? Because they're only getting paid if the price is moving in their direction if they're long, or if the price is moving in their direction when they're short. They don't care about geopolitics. They don't care about the news. They don't care about anything except price. You, not just you, Joe, but you watching this, you need to get to that point as well. Right? Block out all the noise and focus in on what your plan is telling you, assuming you have a plan, because it should be rules-based like this. And of course, my trading plan is linked down below. You're free to have it. There's no cost or anything. You just get it. You got it. And it has nothing to do with the news into it. In fact, on the back-tested results of this trade, on this plan, over 7,000, hang on, where's the slide here? Over 7,000 trades were tested. Not one of them had anything to do with golden toilet tweets. Not one of them had anything to do with panic buying or panic selling. All of it was based on the data. All of it was based on these entries and these exits. That's it. That's how it developed the plan. So if you have a plan and then you decide, you know what, I know better than the market, right? Because there's plenty of people who want to tell me that they knew that this would be the top candle. By all means, you do you, but you're not following the plan, whatever plan it is, because you don't know that that's going to be the top candle. And you certainly don't have 7,000 trades to back up the fact that you don't know that that's going to be the top candle. So you just got to run a plan, whatever that plan happens to be. And then you review your results at the end of the plan and say, how did it go? Was this a good plan? Should I make changes to the plan? That's what you got to do. At least that's what professionals do. I mean, there's plenty of jokers who just say, buy the stock. It always goes up. Trust me, bro.
Their algorithms say short. When the trend is up, their algorithms say long. It's mechanical trading. Goldman reported that
And honestly, that's where you've got to get to. If you want to be successful in the markets, you've got to get to the point where you are a mechanical trader as well.
CTAs were sitting on about a 30 billion net short position going into the ceasefire. But the second the S&P crossed certain trigger levels, these models flipped. And they didn't flip to neutral. They flipped to go long. Goldman originally estimated these CTAs would need to buy back around $40 billion of equities to exit their short positions. But the actual number ended up being $86 billion across just 5 trading sessions. which, according to Goldman's records, is a top 5 buying speed print of all time. And then there was the third domino to fall, the options market. Dealers on the other side of options trades have to stay delta neutral, which means when customers pile into calls, dealers hedge by buying the underlying stock. And Spot Gamma, a leading financial data platform, had flagged a negative gamma regime heading into the ceasefire. That's the regime where dealer hedging flips from stabilizing to pro-cyclical. Price goes up, dealers buy more, price goes up more. You get the point. So a squeeze, plus a systematic flip, plus dealer hedging. 3 dominoes, all falling one after another. That's the rally. That's what we saw. And here's the funny thing. This isn't the first time we've watched this movie. It's a very similar pattern that has played out again and again over the last decade. Because go back to December 2018, stocks had been crashing for...
December 2018, that was Volmageddon. Hang on. That was Volmageddon. Oh, hang on. We've talked about this the last couple of weeks. Hold on. I want to go to this real quick. So Volmageddon was where the market just seemed to only go up. Hold on. Where's it at? And there was a trade on stocks like SVXY. Hang on. I don't want to lose this. Let's go 2 screens. And let's pull this off. Come here. Go over. There we go. Okay. SVXY. There were other ones, but not just SVXY. Hang on. I need to go to a different date. Hold tight. Let's go to 2018. Let's go 2018, 12. Yeah, sure. That's fine. Go to. Oh my. So Volmageddon happened when the easiest trade of all time, which was selling put options on the VIX, because the VIX was, selling call options on the VIX, because this is an inverse VIX. The VIX was at all-time lows. And when the market started to pull back at any tiny itty bitty baby stretch, any tiny pullback caused VIX to go from 9 to 18, right? So a doubling. And if you have an inverse ETF and it more than doubles, which it did, it goes from whatever it was to 0, because it's inverse by percentage terms. So that I don't know if he's about to talk about that, but that was really I lived through that. I did not trade it, but I remember going through it and be like, whoa, I'm glad I did not trade that.
For months on fears of a rate hike. Then Jerome Powell goes on stage and says one word, patient, and the Dow explodes. It was the first time the Dow had ever gained more than 1,000 points in a single trading session. Or we can go to August 2024.
I didn't even talk about it. This is somewhere in 2018. I don't know when it was. But anyway, he didn't talk about that. Too bad.
Bank of Japan hiked rates for the first time in 17 years. The yen carry trade began to unwind, which I've made a video about. Then the Nikkei drops 12% in a day, then bounces 10% the next. These are all different catalysts, but the same mechanisms. And the reason this keeps happening is that the structure of the stock market itself has changed. 20 years ago, the market was dominated by humans. Portfolio managers reading earnings reports, analysts modeling cash flows, people making discretionary decisions about what companies were actually worth. But now, that market is basically gone. Today, 63% of all US stock funds are now held by passive indexers. That's more than $13 trillion of blind money that doesn't read earnings reports or care if Apple had a good quarter. It just follows the index on autopilot. And because most passive funds are market cap weighted, the bigger a company gets, the more of it they buy, which is how the Magnificent Seven now makes up over 33% of the S&P 500. So a massive chunk of the market isn't being priced anymore. It's receiving allocation on default. And what's left of the active investing side has also changed. The hedge fund industry has consolidated into a handful of giant multi-strategy funds that dominate the industry. The Millenniums, the Citadels, and the .72s of the world. And their assets under management have grown exponentially over the last decade. These funds typically run at 4 to 8 times leverage with strict drawdown rules, which means when they hit a drawdown limit, they don't sit in a conference room and debate whether the Fed is going to cut or whether the war is really over. They sell immediately. And underneath all of this is the options market. Because now, same-day expiration options make up around 63% of all SPX trading. On peak days, we're seeing over 2 trillion...
Bro. 63% of all SPX trading. So SPX is trading on the S&P 500 index. That's not trading on the SPY. That's trading on the actual index itself. And so let's go to that real quick. Let's explain this. So the SPX is the index. The SPY is an ETF that you can buy on the index. I don't think you can buy the index itself, but you can buy options on the index. And that's what it's saying right here. 63% of it is 0 DTE. Dude, these are Joe, I've said this before, and some of our outliers got offended. But the truth is, a lot of people masquerade as investors who are actually gamblers. Gamblers masquerading as investors. And it seems that 63% of the people who are trading the SPX, they're looking for, either red or black at the casino table. Like, that's it. That's scary. I didn't realize that we had degenerated ourselves to 63% of it. That's nuts.
Yeah, that's way higher than I would have thought. I mean, you certainly see YouTube content about 0 DTE contracts, but 63%, that's huge.
Dude, I wouldn't have thought it was 6%. 63. That means two out of 3 people basically are just betting it for that day. Hey, stocks go up, stocks go down, right? Red or black. That's it. I'm really surprised by that.
63% of all SPX trading on peak days, we're seeing over $2 trillion of notional value change hands in a single trading session. Every one of those options forces a dealer on the other side to hedge in real time, which leads to buying or selling the underlying stock to keep their books balanced. So the dominant players in 2026 aren't analyzing valuations or fundamentals, they're reacting, and when price moves, their reactions stack on top of each other. And this is what happened on April 8th. Once you understand this, once you understand the mechanics behind why markets are irrational.
I almost went back and said there's no possible way that you can say the markets are efficient. In fact, I have a slide for this. Hold on. Here we go. Where did it go? Hold on, Joe. I have a slide for this. Relax. I've noticed that anyone who's ever tried to tell me the markets are efficient is poor. Dude. Yeah. That goes against all the traditional finance bro knowledge, against all the textbooks, because it's the truth. The market operates on fear and greed, and humans are irrational. A efficient market is one where, in a nutshell, the efficient market theory says that everybody who's in the market will act rational based on the news that is available right now. So if you think about it, that means that there are no trends, there are no price changes, because everybody acts rational based on the available information that there is at this moment. But that's not the case, right? Humans do not act rationally when it comes to money. They act very irrationally. That's how outlier works, by the way, is noticing where they get extra fearful or greedy and by how much. And yeah, the efficient market theory is a theory because we can see it in practice, but that is not real. Right. The efficient market theory would say if there's a war, then stocks have to go down. Well, there you go.
Everything starts to make a little more sense. So if you're tired of watching traditional financial media hand you the dumbed down version of what's happening in markets, hit subscribe, because this is the stuff they conveniently forget to cover. Because the stock market we all used to know and love, the one about finding undervalued companies and investing in them for the long term, that stock market is gone. What's left is a giant feedback loop of algorithms, passive funds, and options dealers, all reacting to each other in real time. And the headlines? Well, they're just the narratives people use to help rationalize things.
Dude, that's what I've been saying. I like this channel. You guys need to subscribe to this. Is the casual finance shit. He's speaking the truth here, right? The whole, you got to invest based on the value of this stock, blah, blah, blah. None of that matters anymore. Not in these markets, right? You want to be on the right side of the irrational exuberance, whether it's up or whether it's down. And just ride that volatility in the direction that your trade is based. So, Joe, this was pretty interesting today. What do you think about that video there?
I think it's really interesting, like you said, because it's reflecting on what just happened very recently, right? And I wondered, why is it that we saw this uptick again? Because there is this war going on, and it keeps flipping back and forth. It's closed, it's not closed. There's oil moving, there's not oil moving. So it's interesting to have someone's perspective of what kicked this off. On the other hand, it's really tough to build a plan around that. Who knows when any of those signals would ever occur again. So even if you made a plan, when's it going to hit again, right? So, yeah, I mean, it's interesting to me for sure. What I do with that, I don't know yet.
Hey, that's great YouTube content right there. I liked it. I enjoyed it. Yeah. I would definitely go. In fact, I will go give it a like right now. You guys go subscribe to this channel and throw a like at them over there. All right, Joe, if somebody were looking to save time, make money, and start winning with less risk, what do you think they should do?
They should first go to the Christopher Ewell YouTube channel and subscribe because we're so close to 50,000 subscribers.
We're so close. We're so close. Joe, I appreciate you adding yourself to that we there. That was really sweet of you. We're so close. Yeah. We're at 49. We're less than 900 to go. Less than 900 to go.
Very cool.
So yeah, y'all go subscribe to that channel right there. It's a great channel.
Yeah.
I'm not
and
biased.
Then once you're done with that, go to outlier.com, check out a subscription or trial membership, and then come back and watch one of these awesome videos right here.
One of these 2 videos. That sounds great. And we'll talk soon.